market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone. Happy Monday. Welcome to The Pulse. I'm Francine Lacqua here in London. Now, the U.S. Senate took a major step towards reopening the government after several Democrats broke with party leaders to side with Republicans to pass a deal aimed at ending the shutdown. President Trump sounded an optimistic note on making progress.
Looks like we're getting very close on the shutdown. We'll never agree to give any substantial money or any money to really prisoners, illegals that come into our country. And I think the Democrats understand that. And it looks like we're getting close to the shutdown ending. You'll know very soon. Thank you very much.
Well, very own Rosalind Matheson now joins us to make sense of all of this. So, Roz, thank you for being here. What are the key provisions of the deal?
Well, as you were saying, a group of Democrats has broken ranks to see if they can get this deal through. And what it would do is ensure funding for key agencies and departments, including Congress itself, but also Department of Agriculture, Department of Veterans Affairs for the full year, and other agencies through the end of January. It will pay those furloughed workers. It will recall employees of agencies who've been laid off during this shutdown. It would resume federal spending for state, which is obviously very important. So what it would do, in essence, is start to ease those pain points that we've been seeing across the US, across workers, their families, and the economy during this shutdown so far, which, as you say, it's become the longest one in history. But what's missing from this bill, and this might be the tension point really in getting it through the House, is there's nothing that's baked into this bill about extending those tax credits for Obamacare, and that's kind of the medical insurance credits that people have been getting and are relying on, and that's been really popular with US voters. There's nothing in this bill about that. There's a promise, apparently, to have a vote on it in December, but a promise is quite different to having something baked into a bill, and that's the biggest omission.
Roz, what comes next for the legislation, and could the shutdown actually be over this week?
Well, possibly, but there are some steps to walk here. So first of all, it has to get through the Senate. There was a procedural vote that obviously cleared the way. We don't know exactly when that vote may happen. Maybe it happens on Wednesday, but then it's also got to get through the House, and the House has to be recalled for that. And there it's obviously much more tricky because you've got a lot of Democrats who'll be unhappy at where it leaves, again, those extensions for the tax credits for Obamacare, perhaps aggrieved at their own colleagues for breaking ranks on it. Could they hold things up? I mean, even one senator can, in procedural ways, hold things up for days in the Senate. So there's no guarantee it will get through by the end of this week. There's obviously a goal to get it through as soon as possible, but you've got a number of potential roadblocks there along the way, and it's not guaranteed at all to get through the House.
Rose, thank you so much. Rose Matheson there with the very latest on the shutdown. Also on point when it comes to close. Now let's turn to the markets and bring in Bloomberg senior equity strategist Michele and Sophie, Huynh, portfolio manager and strategist from BNP Paribas Asset Management. I love that everyone on TV today is wearing red, which of course means that the market's seeing risk on. They're all in the green. Sophie, first of all, there does seem to be a little bit of hope actually on the markets that, the government shutdown comes to an end, and then we can, I guess, go back to focusing on AI valuations. What do you think will support the market going forward?
I think there's the risk that we could have the right tail risk materializing. So we've been through monetary easing for a year and a half now. Fiscal support is still ongoing. We haven't seen any fiscal tightening anywhere. So there's a risk that starts to feed into the system through the interest rate sensitive sectors, but also through consumer recovery. And we're actually starting to see green shoots of recovery in Europe, Sweden, for example. But what if it's going to be broader and we have like upside surprise in the next quarters?
So when you look at the K-shaped recovery, which everyone's talking about in the U.S., what does it? Does it have an implication for AI and AI valuations?
So the K-shaped recovery is basically, at the moment, some people have been left behind because of this AI technology innovation and what we're going to see. I think the fact that we still have a K-shaped recovery is actually a positive sign for AI valuation, meaning that we haven't seen AI yet feeding throughout the different sectors and throughout the economy. So I'm more hopeful on that than I would say the street.
Michele, you focus a lot on all of the earnings and a lot of the companies. Like, what are you seeing overall?
So especially in the US, the earnings season has been really good. It's been really good in Europe as well. The bar was lowered again before the season, so it's not so much of a surprise. What's interesting is valuations now, you were talking about that earlier, they're a bit stretched, especially when it comes to the tech sector in the US. Mm-hmm. But actually, you know, like every single time, bubbles, you know that there is one when they pop and not before, and it can go on for a very, very long time. At the moment, they're delivering earnings, and the growth is there. So we still see signs of stress on the earnings side. I mean, if you look at capex commitment from the AI hyperscaler, for example, they're huge. It's expected to be like 80% of their cash flows next year. There's a point where it's going to be stretched. It's already looking a little bit stretched.
Sophie, I mean, you also have an interesting point when you look at tech and financials. You basically argue that S&P 500 profit margins should have been flat for the past 2 years, but then everything's kind of changed because of AI investment.
Exactly. So if you look at profit margins, we're nowhere where we were back at the peak of the tech bubble. So if you try to calculate the 12-month forward P for the S&P adjusted for profitability, the S&P would be trading only 17 times. Versus the 22 times that is used as a comparison for the tech bubble. So I think for now everything looks good. But it doesn't mean that some stocks are showing signs of frothy valuation. Mm-hmm. But at the same time, I also feel that if you're not on board with this AI innovation and also transformation, there's a bigger risk to be left behind than overspending.
Sophie, I mean, overall, how important, the Fed is also having these stabs in the dark because they don't have the data. So I know we've been relying a lot on the private data, but is this going to be the biggest game changer if we have the end of a government shutdown? Is finally we'll have to get proper data, and that could really change what we're expecting from the Fed because of the U.S. consumer?
So if you look at U.S. consumers, so through alternative source of data, so consumer credit card or the equity market, so consumer discretionary core weight versus the market, or consumer confidence, it's also quite low. So I don't know how much the data could bring on the table and say it's much higher or worse. So we are going through these ongoing non-recessionary cuts that is going to keep feeding into the system. So I just think that unless we have consumer demand feeding into banks' credit risk, for now it's still looking good.
Michele, what can you tell us in terms of earnings season? So Sophie says the bar was low, so we'll get to that in a second. But actually, was there a material difference between being a U.S. company and a European company?
The big thing was tariffs, like how the tariff would feed into earnings and how a company would navigate that tariff, that new thing, which was tariffs. And actually, from what we see, from what we hear, they've been managing pretty well, whether it's in the US or in Europe, through different things, price hikes, cost cutting. Generally speaking, it's been okay, and I think that's what's been reassuring investors over this earnings season, both in the US and in Europe. So at the moment, we don't see a lot of stress. There was like we said, the bar was low. There was a lot of pessimism about European earnings this season. They were supposed to be minus 1% or zero. Actually, we're tracking low single-digit growth. In the US, it's stellar thanks to all the tech sector. But overall, pretty positive.
Pretty positive, but you think, Sophie, that the bar was low, which I like the way you put it. So we weren't expecting too much of this earnings season overall.
The bar was very low. So if you look at for Europe, the expectations were really low. So if you look at EPS surprises for US, the US market is beating by 7%, Europe by 1%. I think the point that Michael was saying, as in cyclicals have beating defensive in terms of earnings, I think the impact of tariff have been a bit overestimated. I think we're starting to collect a bit the benefits this year.
What's your take, Sophia, on the energy sector?
So the energy sector, in my view, is one way to potentially play the write-down risk. So much pessimism there. Everyone is bearish on the sector and also on the oil price, where the OPEC supply hikes, I think, is very embedded in the price. There's no geopolitical premium that is reflected on oil price. Yeah. So that's how I started. If you start to have the write-down risk feeding into the economy, we have some mini cyclical recovery. The energy sector and the oil price will be the start to reprice higher.
Has this changed also a lot of the outlooks for the company? So do you look at it, Michele, through this sector, or is it actually just how much energy costs will have to go up for a lot of companies?
So there's two things. The low oil price is a positive. It's a tailwind for a lot of companies like chemicals or companies that are use a lot of oil to produce their products. But at the same time, as a market, energy earnings are very important for Europe, and so low oil price is not a really good thing. And so that's actually one of the reasons why Goldman Sachs strategists are more pessimistic than the consensus for next year. That's because they forecast between $50 and $55 a barrel for next year. And that will feed into European earnings negatively on that side, just because oil companies are important for Europe.
Michele, also Diageo, it's gaining the most in 5 years. They have a new CEO. Feels like a big deal.
Well, there's one thing. We're talking about defensive and cyclicals. The defensive stocks, all those beverage companies, they've not doing so well lately. So at the moment, there's a lot of switch between cyclicals and defensives. And any good news on the defensive sectors, whether it's beverage, foods, are creating a lot of demand, just either it's short covering or rotations. We see a lot of that.
Okay, and finally, Sophie, what do you do with gold?
We're still long. We've been long since July 23, so it's been an amazing call. So we have this multi-year trend view in mind, but we want to play the short-term ranges. And it's clear that the fact that it has become a much more financialized asset, there's much more volatility, so we want to leverage that too. But yeah, we're long.
Okay, fabulous. Thank you both for joining us. Bloomberg Senior Equity Strategist Michele Msika and Sophie Huynh, Portfolio Manager and Strategist from BNP Paribas Asset Management. Coming up, world leaders left COP30 in Brazil, agreeing efforts to tackle climate change are moving too slowly. We'll be joined by Goldman Sachs' EMEA Natural Resources Research Head, Michele Della Vigna, to discuss the energy transition. That's next, and this is Bloomberg.
Earnings season is here.
It is a busy, busy week for earnings.
More buybacks, more dividends, margin compression.
Bloomberg is first to break the numbers.
We have some earnings crossing.
We'll bring you Deutsche Bank, UBS smashes Santander, beats on net income.
Investors brace for more earnings.
Let's get the reaction and context.
With the smartest insights.
Maybe this German fiscal stimulus is going to start to hit the economy and come through in corporate earnings.
Continuing coverage on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Novo Nordisk shares are higher this morning after it bowed out of a race to buy the American startup Metsera. The obesity drug maker has agreed a $10 billion deal with Pfizer after a tumultuous bidding war. Now, for more, we're joined by Bloomberg's senior healthcare reporter, Naomi Kresge. Naomi, so good to speak to you. So was this a must-win for Pfizer, and what does winning mean for the company?
Yeah, this was really a must-win for Pfizer and for Pfizer's CEO, Albert Bourla. But he's facing patent expirations that will probably cost the company $15 billion in sales by the end of the decade. And he really is in the market for assets that can help him recoup that and grow despite this. And they have tried several times to develop obesity drugs inside their own pipeline, and each time it hasn't worked out. So this was really a deal that enables them to vault back into a market that they had failed to enter under their own steam.
So, Naomi, where does this leave Novo? And actually, will Novo's CEO keep doing deals?
He has signaled that he will. He sent out a letter to senior managers over the weekend to his executive team saying that, they will keep on looking for assets, keep on looking for things that could be complementary to Novo's portfolio in obesity and diabetes. I think we're anticipating them to look at deals that could help them address diseases that are linked to obesity, to comorbidities. So definitely they'll still be looking in this space, looking at everything in the space.
Naomi, thank you so much. Bloomberg senior healthcare reporter there, Naomi Kresge. Now, COP30 is underway in Brazil, and over the next few weeks, negotiators from nearly 200 countries will be thrashing out how best to cut emissions. A topic central to discussions will be the AI boom, which poses a new challenge, with the power demand from data centers expected to quadruple within the next decade. Well, joining us now is Michele Della Vigna, head of VMA Natural Resources Research at Goldman Sachs. Michele, thank you so much for joining us. I know you're also here to actually work on a conference called Carbonomy, which is see how do we get to net zero. First of all, are we on track? Are companies willing to do what it takes to be on track?
I think the focus is completely changing. I think we've mostly spoken about energy transition in the last 5 years. I think when we look at the next 5 to 10 years, it's more likely to be energy addition. We need more and more energy. We can't yet give up hydrocarbons, but we need to add renewables. We need to add new ways to be off-grid for some of the big data centers with things like fuel cells, with nuclear. I think the focus is shifting away for the moment from pure decarbonization to growth. It needs to be sustainable growth, but the focus is clearly growth for the coming years.
What does that mean, Michele, in terms of changing the perception or the investments that company put in place?
I think it changes completely the way we look, especially at some of the incumbent energy companies. It's no longer about how do you shrink your core business. It's about how can you grow it, because energy security is paramount, and on top of it create new businesses in low carbon power. And it's extraordinary because energy always used to be movement and industry. Now energy is becoming intelligence. And there is a completely new world. And I think companies need to adapt for it and have growth strategies for it. And that's why I think the sector is so exciting at this point in time.
How do you see it changing exactly?
Well, first of all, we haven't had power demand growth in the West for a decade, and now it's coming back. That means new grids, that means storage, that needs new power generation, and all of that will require also more natural resources, gas especially, but also oil, uranium. All of this, I think, creates a new growth mentality that, by the way, still needs to come through for a lot of these companies that have mostly just focused on dividends and buybacks for the last 5 years.
But, Michele, first of all, do we have enough of the stuff? Because actually, if we're going to keep up with the AI demand, it doesn't look like we're going to do it right now, especially not in a sustainable manner.
Yeah, I agree. I think we have the resources, but the problem is we've underinvested. Look, for instance, in things like oil. On our analysis, the reserve life of oil companies is down 25% in the last decade. They haven't explored. Look at things like grids. We need a major step up in investment, and we need much faster permitting. What I find fascinating, for instance, when I look at the US and different states, is that in some way, in the energy transition, a state like Texas has been more successful than others because they have quick permitting. I think it all comes back to permitting and the ability to build the infrastructure.
So where do you see, with OPEC actually making decisions that always get questioned, but in the end, it always feels like they didn't mess up. They actually always got it right.
Absolutely.
How do you see demand for oil products going forward?
Demand keeps growing. I think the view that peak oil demand is this decade, I think, has to be totally retired. We think peak oil demand is well into the 2030s. And for that, we need more resources, we need more production. We've seen a very resilient oil demand growth this year. I think we will see it again next year and the one after. Unless there is a recession, oil demand will continue to grow. But the problem is when we look at non-OPEC supply, it's growing this year, it's growing next year. But after that, we think it goes into permanent decline. And that poses a serious challenge to the market and an amazing opportunity for OPEC.
But is this because of shale in the U.S.? You have so many factors, right? There's Russian oil that now got sanctioned even more.
Yeah.
But also we don't really know what to do with the U.S. shale because they have to break even at a certain point.
Yeah, I think it's two things. Shale, like every basin, after 15 years is maturing in a very graceful way, but it's maturing and is going ex-growth. But also the rest of non-OPEC is now bringing on stream all of of the big projects that it committed to pre-COVID, delayed, coming on stream, but it didn't replace that pipeline of project, which means that after this big growth in the next 12 months from Brazil, Novo, Guyana, etc., there really is only decline from 2027. And that will be challenging, especially in a world that keeps growing.
Michele, what does it mean? I mean, if you look at this equilibrium, can actually renewable energy take the mantelpiece, right? So if there's less of, fossil fuel or oil, can they make up for it? But at what cost?
I think at the moment renewables work perfectly with natural gas. That is a stable system that manages intermittency and seasonality and is lower carbon than any power system we have at the moment. I think that is the system of the future, and in many ways, again, a state like Texas has shown what a success story it can be, but we need both. If we only push on renewables and forget natural gas, we have intermittency problem. If we do the opposite, it's expensive and higher carbon, which is why I think the two very much go hand in hand.
But even if you look at renewables, is there enough of the natural resources that need, right? So rare earths, again, they're not that rare, but it's quite rare to mine them in a certain way, but also copper.
Yeah, there is, but it's very dependent on few countries, especially China. There's no doubt that the solar revolution of the last decade has been almost entirely reliant on China. Are we happy for that to continue or not? That is a key question. We've done an analysis to look at what tariffs would be needed for a local industry to be developed in Europe and the US as substitutes China on some of this equipment. And it would be big numbers, like 50 to 100%. So clearly this is a material question.
Would we have the money?
Yes, but it would make decarbonization 30% more expensive. So this is a give or take. We can build a local supply chain, but then decarbonization is 30% more expensive. There's no win-win.
Michele, what's the right way to frame COP30? What do you think can actually be achievable from leaders in a meaningful way without making promises that never come to anything?
I think in this period of political division, I think it's very important to be very practical and focus on practical solutions. So first of all, I think carbon markets are very important, and especially giving a new life to the voluntary carbon market and enabling the money from the West to be spent in really cheap decarbonization projects in emerging markets, I think is absolutely key. Second, I think focusing on the efficiency of the current industrial plants, especially on things like methane emissions, making natural gas lower carbon, more reliable. I think those can be practical wins that can get us at least a few steps closer to net zero.
Michele, thanks so much for joining us. Michele Della Vigna, there, head of EMEA Natural Resource Research at Goldman Sachs. Now, coming up, we discuss how the German machine tools and laser tech company called Trumpf is handling the geopolitical uncertainty. We hear from the company's chief technology officer next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The U.S. Senate takes a major step towards ending the longest government shutdown in history as a group of Democrats breaks ranks to support a deal. TSMC adds to the uncertainty around the AI boom as the chipmaker reports slowing growth in monthly sales. Plus, Chinese consumer prices rise unexpectedly, boosted by holiday spending, but analysis by Bloomberg suggests that deflation is worse than official data show. So snowy weather is adding to the air travel chaos in the U.S. 10,000 flights were canceled or delayed on Sunday alone as bad weather in Chicago compounded the disruption caused by government shutdown restrictions. Well, Bloomberg's aerospace reporter, Al-Rashdan, joins us now. Lean, thank you for being here. So how bad is the disruption, and how much of it is actually tied to the FAA staffing crunch from the shutdown?
Good morning, Francine. So we have over 10,000 flights cancelled or delayed for yesterday. Today we're seeing over 1,400 flights are cancelled. A lot of it is due to the government shutdown. Air traffic controllers are not being paid, so they're not coming into work. And this is coming on decades of staffing shortages in control towers. This is an issue we've faced since COVID. And like you mentioned, on top of that, we have unfavorable weather conditions, especially in Chicago, where we have a storm, and that's one of the biggest airports. Delta is really struggling in their hub in Atlanta. It doesn't seem like things are getting better, and we're just waiting to see if the shutdown ends or not, and how that will have a ripple effect on aviation the next few days in the U.S.
So how likely is a Thanksgiving travel meltdown, and what is actually the potential economic hit if these cancellations continued into Thanksgiving?
Well, the U.S. Transportation Secretary Sean Duffy thinks that it's very likely that travel during Thanksgiving and the holiday season will come to a virtual standstill. Air traffic controllers are even less likely to come in if they're not getting paid during the holiday season. And this is going to have, the Trump administration said they would expect a negative fourth quarter, and A4A, an airlines trade group, said that they estimate between $300 to $600 million in losses each year, and clipped from the U.S. economy, each day that the shutdown continues for.
Thank you, Lena Al-Rashdan there with the very latest on this U.S. air traffic situation. Now, geopolitical uncertainty and the slowing global economy have dragged on a revenue at Trumpf, a market leader in machine tools for industrial manufacturing. Now, the German company see cautious signs of recovery and adapting some of its strategies, including a pivot into the defense sector, using its laser technology to help defend against drones. Well, joining us now from Berlin is Berthold Schmidt, the company's chief technology officer. Berthold, thank you so much for being with us today. So first of all, how's the company doing? What are you most excited about in the next 12 to 18 months?
Yeah, good morning, Francine. It's a pleasure to be with you. As you know, Trumpf is a technology-driven, family-owned high-tech company that is around for more than 100 years. And for the last decades, our key drivers were the machine tools and industrial lasers. And over the past 10 years, we have added what we consider another pillar in our growth strategy, which is the semiconductor market. And here we provide systems and subsystems to key technology players in this industry. And we have grown this section to around €1 billion in sales, which makes something like a little more than 20% of our overall revenue. And our clear plan here is, in this market, to outpace the general growth with our key customers. And I think with the technology we have developed over the years, we are well set up here.
Mr. Schmidt, can you give us a sense of actually, what happens with defense? I know it was end of October that you signed or you announced a partnership to try and develop your laser, solutions for defense purposes. This feels like a sea change. So what kind of timeline do you want to have these systems in place to actually protect against drones?
Yeah, I think first of all, I need to point out that going into this activity is not for fundamental business reasons. It's really a core belief that also Trumpf has to provide his share in making our country, Europe, more protectable against attacks, and therefore we decided to make that step. Just a pure timeline on developing these systems, as was pointed out during our last press conference, with more than 2 to 3 years, shows that this is not a reason for making fast money. It's just a fundamental belief that we want to play an active role in this area.
Trumpf has also come up with a new semiconductor strategy this year. What's new and what can you tell us?
I mean, the semiconductor strategy, in contrary to defense activity, is really a core part of our growth strategy. Here, we are working with the core players in the market, like ASML or Applied Materials, to drive the next generation of hardware systems that will power the further surge of the AI industry. And I think that's something we continue to focus on. We work with our key customers. We have our engineers at their R&D labs. We try to push the boundaries of technology forward. And when you think about, we have more than 150 different projects in this field currently ongoing. It's quite a significant part of our growth strategy.
When you look at, the rare earths export controls, which are looming, although they're relaxing a little bit, what are the possible effects on your supply chain? How are you dealing with this?
Yeah, I wouldn't say it's neglectable, but we have only a limited exposure to these rare earth materials. Nevertheless, we need to naturally look at the current developments in world economy here. We try to protect ourselves by having an increased stock build. We try to establish multi-source agreements. We continuously monitor with our supply chain organization the actual developments in this industry, and therefore I personally believe that in particular Trumpf is well protected to cope with fast changes in the market. If there is a fundamental totally change, naturally we also have a new situation, but looking forward at least to the next 12 months without any significant changes, we feel well set up here.
Mr. Schmidt, I mean, it's so interesting, hearing you talk about the fast change. It feels like everything is changing on a day-to-day basis. So how difficult is it to set strategy and priorities when things are moving all the time?
That's a good question, Francine. I think when you play a significant role in the semiconductor industry, then you're used to fast changes. I mean, we always see this industry going up and down in fast-changing cycles. So this must be part of our general business strategy. We tackle that by implementing high level of automation in our production lines, so that we can breathe with the requirements of our customers faster. These systems, meanwhile, are AI supported, and I think in that way we create a very sufficient supply chain on top of being really on the edge with our technologies to help our customers to bring the leading products into the market.
Mr. Schmidt, when you look at the ability for Trumpf to actually build on your own supply chains, how does that change? Are you looking to be more self-sufficient? I know, for example, one of your customer is a Dutch chip maker, ASML, and they're constantly being taken in all of this. So I wonder also how your relationship with them is.
Yeah, I mean, with ASML, we have a very tight relationship here. If you think about that, ASML provides this EUV lithography system, which is considered being the most complex technology system in the world into the market. And our share is not insignificant. I mean, we are providing the laser light source here, which is a very complex technology by itself. The laser by itself weighs 20 tons and consists out of 450,000 piece parts. So you can imagine that is quite a significant share we are providing here. And this is naturally putting us on some challenges regarding the supply chain, but we are really able to cope with that. By the way, that's not the only part. We have here multiple very complex systems we are supplying to other wafer fab equipment manufacturers in this industry, which have similar challenges. But so far, I think we have a very forward-looking technology and supply chain roadmap that helps us to cope with these challenges.
So interesting. What a pleasure to speak to you, Mr. Berthold Schmidt there, the Chief Technology Officer at Trumpf. Now, consumer prices in China rose unexpectedly in October, but economists say it's likely to be fleeting, with the deflationary pressures remaining entrenched. For more on this, Bloomberg's Jenny Marsh joins us now from Hong Kong. Jenny, so why is CPI up for October?
So, yeah, it was a big surprise. CPI went back into inflation in October. I think economists agree today it's probably not going to last. China had a big national holiday in October, the Golden Week. So all of the country was off work, out spending, sort of traveling, visiting relatives, and that's really driven up the prices just for that month. And also, interestingly, economists are saying today as well, the surge in the price of gold is also having a big impact on core CPI here. So there's sort of a few kind of underlying factors. When you look at PPI, so producer prices, that was its 37th month of deflation. And so what we are seeing is, the industrial side of the economy saw very much an entrenched deflation. And unfortunately, these consumer prices are still experiencing problems. And I think that the October uptick is just sort of a fleeting sort of bit of good news.
Jenny, Bloomberg's big take today is on the true cost of China's falling prices. So what's the story there, and how does this fit in the overall data picture?
Yeah, so the big take today really is looking at that sort of contradiction between the official numbers sometimes and how deflation actually feels on the ground. And so CPI has sort of been hovering around zero or slightly below for a couple of years now. But, we're seeing these sort of brutal price wars in China. And so what we did was we looked at about 70 everyday items in China that maybe the consumer price basket doesn't capture. And what we found there was sort of price drops far, far deeper than what the CPI sort of reflects. So BYD cars in this year, 27% cheaper than they were just in 2023. The price of pears is down 31%. Eggs 13%. So you can see there how things feel so cheap sort of on the ground. And that could be a good thing, right? Like, inflation is obviously a very big political problem, and things being cheap could be a good thing. But what it actually sort of does mean is it's transferring through to companies who are sort of having to slash prices to stay in competition. And our analysis showed that 25% of listed companies in China made a loss this year in the first half. And that's a record for this century. So it's really spelling a lot of problems for the Communist Party in terms of sort of job growth, job sort of stability. And so this is a really big problem now ahead for policymakers that they're going to have to try and tackle in the months ahead.
Jenny, thank you so much. Jenny Marsh there with some great reporting on things that you need to know about. Now, coming up, as TSMC's sales growth slows, is the AI chip boom finally starting to cool? We'll have more of that next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the BBC's Director General, Tim Davie, is, to resign amid allegations that the broadcaster misled viewers by editing President Donald Trump's remarks in a documentary. While the clip made Trump appear to say that his supporters should, quote, walk down to the Capitol and fight like hell. In fact, he said they should cheer on our brave senators and congressmen and women, while the fight like hell remark was from a different part of the speech. Well, news chief Deborah Turness has also quit over the controversy. So to discuss what that means next for the media landscape, let's bring in Rosa Prince, the UK political commentator from Bloomberg Opinion. Rosa, thank you so much for joining us. So what happened with the BBC and why?
Well, there was a report into the BBC's conduct, not just on this documentary about Donald Trump, but on a range of issues, including the BBC's coverage of Israel, including its coverage of trans issues and other kind of hot button topics that you might say are part of the sort of woke wars. And basically it accused the BBC of bias. There was a bit of a head of steam building, and over the weekend, as you say, Tim Davie and the head of news, Deborah Turness, have both now quit. And it really plunges the nation's broadcaster into a state of crisis, because the BBC is such a national institution here in the UK, but also around the world. So I think a lot of people will be looking to see what happens next and whether the BBC can get itself back on track, restore its reputation as a source of trust and honesty.
Rosa, what are the consequences of this?
Well, big consequences, as I say. Here in the UK, the hunt is on, obviously, for new leadership, and the BBC is due to have its charter renewed. It's at the moment funded by quite a unique source of funding, which is from subscription by pretty much everyone in the country. That has been undermined as the BBC's reputation has been undermined. But I think globally there are other consequences too. The BBC is a voice, it's supposed to be a voice, a beacon of freedom and something you can trust, a trusted source globally. I think that needs to be restored. And then there are broader consequences. For example, Donald Trump, who was very happy about the latest developments, the BBC documentary was perhaps raising some questions, maybe some valid questions about his conduct on January 6th. But instead, it's the BBC that has come into the firing line. And I think that's a product of these own goals. I think there were criticisms to be made of that Panorama documentary. Certainly, those were not editorial standards that any news organisation, Bloomberg, would not have done what the BBC did in that case. And also its honesty and approach in other areas. So I think the consequence here is that the BBC really is going to have to work hard to restore trust, and I'm sure that there will be lots of people globally who will be watching what happens.
Rosa, thanks so much. Rosa Prince, Bloomberg's UK political commentator. Now on to corporate news. On Taiwan semiconductor manufacturing has reported slower October sales growth, hinting that red-hot AI chip demand may be losing steam. Now shares still up 37% this year, but with valuations stretched and supply tight, investors are watching for cracks in the boom. Well, we're joined by Bloomberg intelligence analyst Matthew Bloxham. Matt, thank you for joining us. Look, first of all, is this the first sign that AI demand is plateauing? I feel like we ask ourselves this every 2 days, and it's plateauing and then it's not. But could this be really it?
No, I don't think it is, to be honest. I mean, I think if you put it in context, I mean, revenues are up about 17% in local currency, about 22% in US dollar terms for October. It's trending in line with the guidance they gave when they gave their Q3 update. So I think this is where we're expecting it to be. And it will be, well, it was the single largest revenue month for the year to date. So, you know, things are still growing, things are still very good. If anything, you know, for TSMC in the next 6-12 months, it's a capacity constraint issue. You know, we saw that Jensen Huang's been visiting Taiwan, you know, making overtures to TSMC to make sure that they're you know, still at the top of the pecking order when it comes to the kind of order book. And so that's the big issue for them next year, I think, is bringing enough incremental capacity online quick enough to meet the demand out there. And I don't think they're going to be able to do that.
Matt, we've also heard from the Nvidia CEO saying, you know, he still sees strong momentum. How are executives kind of reconciling this optimism with these soft numbers?
Yeah, I mean, look, I wouldn't necessarily characterise them as soft. I think you know, what we're seeing, and I think what there's no doubt about is that companies like OpenAI, Microsoft, Google, Meta are spending huge amounts of real money on real infrastructure, and the biggest part of that infrastructure spend, or one of the big parts, is the Nvidia and other AI accelerated chips that are going into them, and TSMC is critical to that. So I think, you know, whilst that capex spend from the industry is high, which I think is going to be through the next 12 months, possibly longer, then I don't think there's any issues for TSMC here, really. Beyond that, where companies like OpenAI have to start generating revenue, demonstrate there's a business model, that's where perhaps the capex model starts to change, and that's where there's a bigger question mark.
But in general, there seems to be like rising competition, right, in this space.
Yeah, that's fair. Yeah, that is fair. But I'd say that kind of affects more the Nvidia level than necessarily the TSMC, because all of Nvidia's competitors, emerging competitors, are also TSMC customers, and so there's a bit of a, you know, bigger battle, if you like, now for the TSMC capacity. It's not just Nvidia that's demanding it, it's others too.
Okay, thank you so much. Of course, our Matt Bloxham there with the very latest on AI and some of the things we're watching, including TSMC. Now, global stocks rallying following news of a potential end to the longest U.S. government shutdown in history. Let's get more from Bloomberg MLive strategist Ven Ram. Ven, so what would a shutdown resolution mean for Treasury yields?
Morning, Francine. I think that, you know, I think a shutdown would potentially have the power to uncork higher yields. But if you look at the swaptions markets, they are kind of pretty muted volatility there we are seeing. They're thinking that, look, I mean, while we are bound to get more data, I think the biggest data point that we've got in the past week is a Challenger Gray report, which showed that, look, the layoffs are the highest in more than 2 decades. So that is weighing on the markets, and the markets are assigning more than a 55% chance of a rate cut in December. To the extent that that pricing shifts, the market volatility will be uncorked. But even if that pricing shifts and the markets say, okay, you know what, the economy is doing okay for now, and we don't need that rate cut, I think that the upside to the 2-year rate is just about 10 basis points from here, because if it goes beyond 368, 370 levels, then that would negate the Fed's easing cycle, which is unlikely. So I think that the 2-year yield is going to be capped at 368 no matter what in the short term.
So risk sentiment overall seems to be recovering. This is partly due to the shutdown, but where do you think then stocks go from here?
Well, I think that stocks have proven that every time there is a dip, there's dip buying, and I think that investors are kind of overlooking the risk of frothy valuations here. And I think that the longer they keep kicking the can down the road, the worse it's going to end. I think this is a bit like the Cinderella story, right, where investors think that, everyone knows that it's going to turn into pumpkins and mice at some point. My only problem, as Buffett says, is that there is no clock in the room, and everyone thinks that they can make a rush to the exit before the stampede begins. And we know from history that's not how it works out.
So, then how do you think it'll work out? I mean, again, this is the impossible question, but I guess with the shutdown closer to an end, we have some more data. So you could also see a repricing of expectations from the Fed, or do you think that what we had in terms of private data was enough?
Well, I think that, if the Fed pricing is priced out, as we were discussing earlier, I think that would give kind of reality check to the markets about higher rates, about the prospect that they can't take low rates for granted. And also, the markets are overlooking the stress from the credit sector. I think that we have had innumerable headlines in the past month about, things in the credit market not going quite right. And the credit market is priced for perfection. There's just no scope for any disappointment. And that's the same story kind of translates through into stock earnings, where, we've had many of the stocks priced at 60 times multiples and forward multiples, which is just not sustainable.
But then overall, is there also a big difference between the U.S. and Europe and Asia? I know we keep on talking about, K recovery, but I always love hearing your thoughts on things that may be a little bit idiosyncratic.
They are actually quite different. I mean, quite starkly different, if you ask me, Francine. Because if you look at Germany's aggregate market cap, it's like 64% of GDP, whereas in the US, it's more than 200%. So investors have thrown caution to the winds and chasing US stocks. But here's the stock market. Okay, it's not going to grow as much as the US stocks are in terms of market capitalization. But in terms of growth, if you look at Germany's performance, albeit an economy that is kind of growing below trend, the valuations are so compelling that investors can't overlook them. The same is pretty much the case in the UK as well. UK's aggregate stock market capitalization is just about 100% of GDP. So those are two reasonably priced markets in Europe, whereas you've got US markets running up and away. So I think that, there's going to be a bit of rebalancing between the geographies. And as the froth in the US market comes off, I think Europe will do better.
So interesting. Ven, thank you so much. Bloomberg MLive strategist Ven Ram. Now, there's also an exclusive conversation with the Fed's Alberto Musalem. That's on open interest at 2:30 p.m. London time. Up next, Bloomberg Brief.